What's up, traders? So I get a lot of questions on my social media about how I trade and why I take the pullbacks that I do, how I identify them. And I don't make any secrets. I'm not trying to sell a course or anything like that. I'm very open and honest that I look for 50% retracements. Really simple. A lot of people talk about that being a Fibonacci, but that's not where I learn the technique. I spent many, many years studying Ichimoku, and I became at least what I thought was pretty proficient at it. But as I traded longer and got more experience, I began to appreciate simplicity. And honestly, Ichimoku can be a little busy. So I took what I learned about Ichimoku and I just simplified it. One of the things that I did was I just made this indicator, which I'll share below to anybody that wants it. I call it retracement levels, which is basically just showing the 50% retracement from a major high to a major low. It becomes a little more clear when we go down here on the SPY and we look at this level that it pulled back to yesterday from the low from January 29th up to the high of February 12th. Boom, pegged it and went. It's not the only thing that did that. Tesla also did this as well. Let's see if we can get it to line up. Depends on the time frame. Well, we'll just do it manually. From the point it launched to there, boom, some nice price action in here that it matches up with, and up it goes. So why I began to appreciate this was in my learning and use of Ichimoku. And what oftentimes happens is the Ichimoku Cloud will match up with that level. Now, why does it do that? I'll explain to you. The bottom of the cloud, if it's bullish, is called the Senku B. And so what it is the 52 period high and low median, not average. It's the halfway point of the high and the low for 52 bars, then shifted forward. In fact, everything in Ichimoku is based off of 50%. The Kijinsen, which is the green line right here, is the 26 period. And actually, if you look back at SPY, you can see how the SPY, in fact, did just that. There is that 50% that it's showing us from the low to the high there on the daily. And so you can see 50% on Ichimoku. It's built into it. That's the entire premise of it. And a few of the trades I've been very forthcoming about that I'm in and are working now, I put on back on the 27th. One was Boeing. Again, the bottom of that cloud where it went nice and flat was also the 50% from the November low up to the December high, pulled back and went. This was a trade that I posted in TradingView and took. CCL is another one. Again, these all look basically the same, and that's the beauty of using Ichimoku, actually, is the pattern recognition that you can build from seeing these sort of trends happen again and again. The other one that I took yesterday on the pullback was TTWO. Again, has a really nice halfway point, which we can validate by doing our measurement. By the way, I'm using the Fibonacci tool in TradingView, and I just remove out all the stuff that I don't use. And right there. So it matches up. I also like it that we've got some price action, some highs that are it's matching up with there. So this is another pretty good long term that I'm looking at. A few others which have pulled back. Oh, not that one. What was it? Yeah. So this one, not quite as clean with the Ichimoku because, again, I'm using this retracements levels, which is basic. It's nothing fancy about it. It's just shows me as a little cheat so I don't have to draw it all the time, the 50% retracements. And it's just that simple. And I really believe in simplicity in trading. I'm not trying to dazzle people with all kinds of fancy indicators and things like that, because if you look at some people's charts, they have way, way too many indicators. And that's actually why I got away from using Ichimoku, is because for me, it was almost too cluttered, especially when you would get into periods of consolidation and price would move around very quickly. There's a lot of different events where looking for the 50% can be very valuable. Something I keep telling people that are every day worrying about the next crash that's going to come is that if you are just patient and you're paying attention and you don't freak out, when the market does go down, and it will go down, I just don't know if it's going to be this year or next year, look for those 50% retracements. If you go back in 2020, here we have February the 19th, which was the high. We had the COVID scare coming in, and that's a pretty big move down that we had from the top to here. It's about 15%. That kind of movement, by the way, is something that you can expect every other year. Statistically in the market is about a 10% down move. The 30% down move that we had, well, that comes about once a decade or so. But if you were patient and you watched, then you would have seen where on this day, March the 3rd, and then the following day, March the 4th, it pulled back to the 50% of its down move. And of course, there with Ichimoku, we have the Kijinsen. If you want to validate it by looking at the lower time frame, let's say the 2-hour or the 1-hour, let's see if that makes the cloud match up. Sometimes getting that right can be the art in itself. Yeah, so there we have the cloud matching up. At that point, what you can say, if you're using Ichimoku for your risk, is you can say, well, I'm going to know that I'm wrong if price gets on the other side of the cloud. In other words, if the trend changes. Because all through this bullish trend, it shouldn't violate the cloud. Here you had a little scare, but at the point that it made a full reverse here, well, that's your sign that you might want to get out. So if we thought about that and we used that as our risk, then we would have been able to capture the down move from there. And again, it was all started by that 50% retracement from the initial impulse wave. And so there's no reason to fear a crash coming and that you're going to miss it, because there's a very good chance that you will have a chance to close your positions. Let me show you something else that's also really cool for everyone that stayed to actually watch the rest of the video. So let's look at the Dow Jones Industrial Average. This is, make sure it's the index. Yeah. Okay. So we're going to do something fun. We're going to go back in time. Yeah, I'll leave my retracements on. We're not just going to go back to 2008. We're not just going to go back to 2000. We're going to go back to 1929. And this is the weekly. So this is what we all hear about that happened almost 100 years ago. The market was bullish, 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 bullish. Everyone was making tons of money. This was the new normal. Well, we had that huge down move from September 29 all the way down to November. So about a month. And in that time, it dropped 50%. Whew. Wow. But let's measure it. From the peak to the low, here we had our 50%. And at that point, if people knew, they didn't have computers back then, they wouldn't have known to draw it, but some did. Some had charting paper. They had to do it all by hand. Oof, a lot of respect for those people. If they had been patient and not freaked out and not started subscribing to the hopium as they figured, oh, okay, whew, my money's coming back. That would have been a really good exit, or could have started shorting shares as well. I don't think they even had options back then. But if they did, they should buy some puts. So even 100 years ago, this technique of just looking for a 50% move would have actually worked. Now, that's not always the case. Let's look at when it doesn't work out that way. And for that, we're going to look at 1987. Ooh, where's that at? That's the other big crash. So here was another big crash in 1987. Let's measure this one. So at this point, if we look, the character of this move is different. This time it's different. You even had some price action right here to validate when you got up here that might have been a good sell. Oh, is it going to let me? Yeah, cool. That would have been a good sell. Get out of your positions and maybe go short. But at some point, even though you got a little bit of a movement there, it got back above that 50%. Now, let's say that you had sold your positions, cleared your 401k there. Well, at this point, you would be a little concerned that maybe you're missing out on gains. Okay, so you are. So you missed out on a percentage movement of about 10%. I mean, that could seem really, really bad. It could seem bad. But if you had just re-entered on this point, then you could have got back into the market. And remember, this is 1987. What came after that was the 90s, which were, well, I mean, that's the bull run that everyone, Warren Buffett, etc., made their money on. So the key takeaway here is if you play that 50% and it doesn't actually hold it and the market goes back up again, well, remember, what do stocks do? Well, stocks go up. So eventually the market should come back. Where was that? Speed things up a little bit. Yeah. So from that point that it broke the 50%, you had an opportunity to maybe get back in on some pullbacks. People getting a little scared there, as I'm sure they were around 1990. But the next few decades, you would have been just fine. So, hope I've given you guys something to look at, something to pay attention to. If you want to use Ichimoku, that's fine. That's good. Look for levels on Ichimoku when they go flat. Those are your 50%. Or I'm going to leave a link to the indicator, which is free for anyone to add. Trade wisely, guys. See you in the next video.